So if we go to the gold area, we'll see the gold indicator, and the gold indicator has peaked. Okay, you see the light line has peaked well above 1,000. Means over a 1 month period. That means there were like 10 stocks with key insider buying for every one was selling. So that's pretty good. And in fact, you have to go back to 2022 to see that. There's two things here. Why is a peak important? Because that's peak insider buying. That often happens around key support levels for stocks. Now, can't really determine that until a few days or a few weeks later because it's a coincident to concurrent indicator. But it looks like last week, insiders are kind of signaling, yeah, that was a good level. That was a good opportunistic level to buy. And that's where we saw peak insider buying. That gives us some confidence that we've got a really good support level around these areas for mining stocks. Now, that doesn't mean we can't go lower. Sure can. And if we were to go lower, we would expect the indicator to even go higher and look for another peak. But right now, our base case is we've seen some significant support at the end of June from insiders, and they're kind of saying that was a good kind of buying opportunity period. And we're pretty close to that now. So there we go. Insiders indicating that this is a good environment for the contrarians, for the buyers. Risks remain. But this is something we saw back in 2022 in the summer when the Fed was rushing to raise rates after the COVID stimulus. And, it didn't take long after the peak for the senior producers to gain some traction, and so the producers to start regaining their footing. The junior miners took a lot longer to get into their groove. And in fact, because we saw this hiking cycle, the Fed was extracting liquidity, the junior miners continued to struggle. And in the summer of 2023, which kind of reminds me of where we are now, we had the Fed doing another rate hike. And why did they do this rate hike? Well, my view is it because they had to do this stealth QE around the Silicon Valley bank run. So they did that stealth QE, they pumped liquidity into the system, but Jerome Powell tried to get a little cute and take some of that back through a rate hike. At the time, we're saying, oh, this is not going to be sustainable. They're not going to be able to, this rate hike's going to be too risky for the Fed. And shortly thereafter, they started to cut rates again. But basically the junior miners started to regain their momentum early fall of 2023. So are we seeing a repeat of that now? Are we back to like the summer of 2023 where we have a tough talking Fed chairman? So he's going to raise rates. The market thinks he's going to raise rates, sort of. But now we also are dealing with a Fed chairman who's not going to give forward guidance. So that means the data is going to even be more important than ever for investors to assess what the Fed could do, since the Fed's not going to be there holding everyone's hand, apparently. So today with the non-farm payroll, we saw a big reaction because it came in less than expected, so less chance for the Fed to raise rates. So I think this data is going to generate a lot of volatility in the market if the Fed doesn't do the forward guidance like it used to. So that's just something to keep in mind. But my view with respect to the path from here for Warsh is that, look, if he wants to raise rates or get the market to raise the rates for him by jawboning it up, he's not going to be able to do it without giving stimulus somewhere else. And why is that? Well, I'm going to go back to this chart I showed in the last live stream, and that is this net interest expense of GDP from the Peterson Foundation. And what it shows is basically the net interest expense of federal debt divided by GDP. And as you can see, it's starting to go up very, very fast. So if he's going to raise rates, or the market believes he's going to raise rates, it's even going to go up faster. And we're into this kind of uncharted territory. So that means that there's a risky period here for the Fed. If they push up the net interest expense part of that equation, there's going to be a lot of pressure on them to help with the GDP part of the equation, that's nominal GDP, to add liquidity, probably through stealth QE, through probably something like the reserve management purchases program, which Kevin Warsh extended. as his first policy decision, policy act in at the Fed, he extended that program. So it was actually something he did, something that was dovish. Now, perhaps you could say taking away forward guidance is hawkish, but I don't think so, because forward guidance could go either way. No, I mean, he implemented a tool to provide stimulus if it's needed. So I think that even if he does kind of threaten rate hikes, we're going to get this stealth QE type scenario. So kind of like the opposite of what Powell did in 2023. But we're not there yet. So far, it's been all talk, no action. All right. So insiders are kind of giving us a thumbs up.